Offshore banking, structures, strategies, and practical entry points. 1. Defining offshore banking. An offshore account is simply a bank account opened by a foreign non-resident in a financial center that caters to international clients. Contrary to common internet lists, not every jurisdiction qualifies. Germany and Canada are not offshore centers, while the US, UK, Switzerland, Singapore, and the UAE often serve this function. Offshore accounts exist to diversify exposure, provide access to foreign currencies and investments, and secure funds against domestic instability. Footnote: offshore banking is less about palm trees and secrecy, more about paperwork and jurisdictional arbitrage. 2. Why bank offshore? At the surface, offshore accounts act as a form of financial insurance. If a local government freezes domestic accounts, offshore accounts remain operable. At a deeper level, they are strategic instruments in tax planning, wealth preservation, and international structuring. Example: Swiss banks often book deposits into the UAE to avoid Switzerland's 35% withholding tax, thereby preserving both stability and returns. The essence lies in combining banking jurisdictions with investment jurisdictions for optimal outcomes. Footnote: offshore banking is essentially financial chess. The taxman usually prefers checkers. 3. Who can bank offshore? Nearly anyone outside restricted or sanctioned states can open offshore accounts. Requirements include identification, proof of residence, an initial deposit, and a clear rationale. Thresholds vary widely. $25,000 may suffice in Panama or the Channel Islands. $500,000 grants access to private banking hubs like Switzerland, Liechtenstein, or Singapore. Ultimately, entry depends on both financial capacity and documentation. Footnote: banks are less interested in your dreams of secrecy than in whether you can prove your address and deposit funds. 4. Jurisdictional choices. Not all jurisdictions are equal. High-quality centers, Switzerland, Luxembourg, Singapore, the UAE, offer strong correspondent banking, regulation, and reliability. Lower-tier centers present weaker oversight and higher risk. Choices depend on objectives: private wealth management in Monaco, multi-currency services in Singapore, or lower deposit entry in Panama. The US itself, paradoxically, is also a significant offshore hub for foreigners. Footnote: the best offshore jurisdictions are like good coffee, reliable, strong, and not watered down. 5. The offshore banking playbook. Opening an offshore account requires 3 decisions. Deposit capacity. Entry ranges from $25,000 to $500,000 plus, determining available jurisdictions. Purpose. Rainy day liquidity differs from corporate structuring or estate planning. Requirements. Jurisdictions vary by citizenship acceptance, in-person requirements, and reporting rules. Once these are answered, selection of both country and bank becomes feasible. Footnote: offshore banking begins with soul searching. How much can you deposit? And why are you doing this in the first place? 6. Choosing a bank. Critical factors include institutional stability, regulatory reputation, compliance culture, responsiveness, and service range. A neglected but vital element is the bank's desired client profile. Institutions quietly prefer certain nationalities, industries, and transaction patterns. Applying to the wrong bank wastes time and fees. Alignment between applicant and client profile determines approval. Footnote: banks, like people, have types. Do not attempt courtship if you are not their type. 7. Application process. The process generally begins with a video call, effectively a first date with the banker. If accepted, applicants submit identification, proof of address, tax numbers, and in some cases audited financials. Deposit levels dictate service tier. Larger sums unlock private banking, while modest deposits access transactional services. Timelines range from 5 to 15 business days when streamlined through professional intermediaries. Footnote: Offshore onboarding resembles online dating, initial calls, background checks, and the ever-important question, what can you commit? 8. Streamlined entry. Specialized firms offer pre-assessments to match profiles with jurisdictions and banks, preventing wasted applications. This accelerates the process and reduces rejection risk. For individuals, the advantage is pragmatic. In an increasingly restrictive global banking environment, precision is as valuable as capital. Footnote: In offshore banking, efficiency is currency, wasted applications cost more than fees.